All right, so let's get started. So basically, I'm going to just talk for a bit about my impressions from the Berkshire Hathaway 2020 virtual meeting, which was certainly an unusual event. And then if there are questions, I'll do my best to answer them, and also comments, any thoughts you might have. All right, so let's begin. I'm going to talk a little bit about myself, but I think that, there's not enough, I don't want to spend too much time on myself. Enough is to say that I manage a long-term value partnership, silvering value partners, where I, try to compound capital for the long term. So I'll skip the slides about myself and my company because this is not what it's about. I'm going to start, by noting the obvious, which is this is not an usual year. Usually, there's 40,000 people going to Berkshire Hathaway, and unfortunately, this year it was a virtual event, and that's okay. I think in some ways it was easier. In other ways, I missed getting together with some old friends and catching up. But regardless, I think that it's a interesting change. So, one thing I always like to talk about is how do we learn from Warren Buffett? And I think the wrong ways to learn or use what he puts out there is to just blindly imitate what he does, or just kind of blind hero worship. Anything Buffett says is right and so forth. That's obviously not the case. So what is the right way to learn and then kind of use the insights that we get from Warren Buffett? I have a framework that I use with my students when I teach the value investing seminar at the local business school, and that's you want to understand, you want to apply, and you want to customize. So by understand, what I mean is that you want to understand what Buffett is teaching us. You want to be able to apply it in practice because investing is not a theoretical endeavor; it's a practical endeavor. And then you want to be able to customize it to your own situation. And basically, your situation is going to be no different from mine. It's not the same, and so I think a one-size-fits-all approach is not really the best. So let me go on here. And there are three themes that I would say are things that stuck out from listening to the Berkshire Hathaway meeting. And I would say before we even get into these themes, I would say that I was a little bit, underwhelmed, and it's, saddens me to say that. Maybe my expectations were higher in terms of what I would be able to learn, but I think, Warren Buffett came across as somewhat kind of shaken by the current events, which is, in a sense, it's a little scary to see. In another sense, it's kind of maybe somewhat reassuring that it's not that there are easy answers out there and we're just all missing them. It's really a hard time and it's hard to figure out what's going on. So I think that was my overall impression, is that he kind of was not his usual gung-ho self, kind of cheery and, making light of things. He was, pretty somber, and maybe that's appropriate for the times. So I think that the first theme is that Warren Buffett doesn't know, and you know what? Neither do you. And what I mean by that is that we have a situation that really was unprecedented, and it's not even the virus itself. I mean, the virus is going to, be dealt with, and I think, I'm not going to get into the politics of it, but there's evidence that things are not nearly as bad as initial estimates suggested, and we'll see what happens. But I think the virus will be behind us. The question is, what's going to be the the second and third order effects of the cure, of basically shutting down the economy? How will it all play out when things restart? And I would say, I don't know. I mean, Buffett doesn't know. The one he said a couple of things that made sense. One is that the range of possibility has narrowed, but also that the range of possibility is also extremely wide. And I think that he's right. I think a lot of people think about forecasting the future as a point estimate, as this is going to happen. So some people think there's going to be a quick snapback recovery. We're going to really let people go back to work and demand will pick up. Other people think this will be the next Great Depression. And the reality is that's kind of the range, but it's not in any way certain which one it's going to be. So you have to plan for the full range of possibilities. One more thing that Buffett noted that I think is interesting, is that fear is the most contagious disease that you can imagine, and it makes the virus look like a piker. And I think that's right. I think the Federal Reserve kind of arrested the fear in March with its pretty unprecedented intervention in the free market. And maybe that's good, maybe it's not. I suspect that it's both. There's some benefits, and obviously there are going to be some costs, and we don't know what they are yet. But it's hard to imagine what is going to happen. And so I think you have to manage your investments for the full range of possible outcomes. You can't just make a bet that's all going to be great and the recovery will happen quickly, nor can you really just make an assumption that this is going to be the Great Depression all over again. So that's the first theme. So the second theme is that the opportunities were not attractive. Not just that they're not attractive, they were not attractive at the lows of March. Now, you have to put this into context. And the context is Warren Buffett is trying to spend, billions of tens of billions of dollars. So he's really restricted to securities of very, very large companies, right? And so I think that basically, just because he's not finding, opportunities doesn't mean that you or I couldn't find opportunities managing much smaller sums of money. So that's something just to keep in mind. But I think it is interesting that even with the market down a third, Buffett was a net seller of equities between the beginning of the year through the end of April. That says it all as far as what he thinks. He can talk about America being great long-term all he wants, and it's true. It's not that he's lying. He genuinely believes that. But that's kind of the generic platitudes, and that's all nice and good. But we all learn to watch what someone does, not what they say, and what the man is doing is selling, not buying. So, and I think if you think about, especially today, I don't watch the markets by the minute, so I don't know where the markets are now. But at least through the end of last week, the large cap stocks in the U.S. were down something like 12%. That's it. That's not a whole lot. Given that we started at a very expensive level for the market, and that essentially we had a long bull market, and now we had a huge economic shock, but we don't know how much it will impact things over the medium to long term. So 12% is really nothing. So I would say that you want to be just very, very careful, and Buffett is being very, very careful. Now, he is saying that they were willing to buy something for as big as 40 or 50 billion for the right price. So it's not that he doesn't have the money, obviously he does. So he is telling us he thinks that the opportunity set is unattractive at his scale. And I think that you basically have an advantage over Buffett in the sense that you can go and you can invest at in very different situations. Potentially, but even there, I would say the opportunity set is not amazing. I manage far less money than Warren Buffett, and I would say that the opportunity set right now, with the quick rebound that we've had in the markets, is not that great. It's okay, and I certainly have been able to find a handful of things that I'm excited about, but it's not like I have 20 more that I think are amazing that I would love to buy at these prices. So just that's theme number 2. So theme number 3 that kind of surprised me, and I don't know how much it surprised others, but it surprised me, is that Berkshire's value has decreased. Now, we kind of guessed that they lost some money on airlines, and maybe their businesses are suffering temporary problems. So I think that I expected there would be some value decline. I also would have expected that would be at least partially offset by Warren Buffett deploying capital on very advantageous terms. Unfortunately, the Federal Reserve kind of muscled him out in terms of being the lender of last resort, whereas in prior crises, Buffett would have gotten really sweetheart deals, to get companies to survive. The Fed kind of took that role. So he wasn't able to deploy the capital, which I would have thought would be at least a partial, if not a full offset for the temporary impact on his businesses. And the comment that he made that really struck me is that he doesn't think that Berkshire shares are much more compelling as a value right now than they were 3 or 6 months ago. And this is in response to, why aren't you buying back more stock? That is a big, big statement. The Berkshire Hathaway stock was down about 20% year to date. So to say that Berkshire Hathaway, with its meaningful cash holdings and very robust businesses that in theory are built to survive a big negative shock, So to say that Berkshire Hathaway, his value declined 20% or so, give or take, he was obviously not being precise, but somewhere in that neighborhood, that's surprising. And I think what I wish you talked about, maybe either he or Greg Abel, is that what are the businesses doing to really widen their competitive advantage? What are they doing that they can do as part of Berkshire Hathaway that their competitors might not be able to do, because their competitors might be basically just suffering and trying to survive. So I think that they didn't really go in depth on that, and that's disappointing. I think that I would have thought that there are things that their businesses can do that to gain market share, to increase their competitive position, what have you, and that they would be able to deploy capital on the really value accretive terms. And they didn't talk about the former, and they didn't do the latter. So now, this crisis is still young. Look, I would not be at all shocked if the stock market, declined quite a bit from here. I'm not saying it will or won't. I don't know. I'm a bottom-up value investor, but it would make sense if it did at some point in the next year or two. And so I think that there is still time for Berkshire Hathaway to deploy capital on advantageous terms. So we might still get this, value offset. But so far, I would say, it was not encouraging news. So, to summarize, I would say, learn from Buffett, but don't blindly imitate. Figure out how to customize what he's saying to your own circumstances. Just because, for instance, he didn't find something to do that's intelligent does not mean that you shouldn't have bought anything. And if you did buy anything, it doesn't mean that you were wrong to do so. So think for yourself. I also think that the current stock market prices are very, very complacent and are discounting a very quick and optimistic recovery scenario. This might happen, but if it doesn't happen, I would say there's going to be a lot of disappointment. So, finally, I would add that nobody really knows how things will work out over time. So I think that if you are, basically, going to focus on something, you want to make sure you're focusing on, the full range of outcomes. You want to make sure that you are focused on something where there's a disaster scenario, and as well as all the way to a full recovery, and make sure that your investments are positioned appropriately. Let's see if there are any questions in the chat. Otherwise, we can wrap up certainly if there aren't any. But please feel free to post questions if you're watching this live. And certainly, for those of you who are interested, I'll be more than happy to share how I approach investing. So just shoot me an email at the email address on the screen, and I'll be happy to send you Silver Ring Value Partners Owner's Manual, which is where I describe my own investment process in depth. So I'm going to pause for a couple of minutes just to see, collect the questions, and we'll go from there. So it looks like we're going to have some questions from Larson, and Larson says, is thanking me for putting this together, which you're welcome. I'm more than happy to do this. It's easy enough. I know we're all stuck at home, so the least I can do is share my views and hopefully exchange some ideas. So Larson, go ahead, tell us what's on your mind. So we're just gonna wait for Larson to type in his questions. So if other folks have questions, feel free, just type them into the chat, and I'll do my best to give you my perspective. So let me read the first question from Larson. So my first question is, do you think going forward that the classic, quote, economic modes that we learn about from Graham and Buffett are gone or have radically changed? That's certainly a fair question. I mean, I think, Buffett has been on the record in the past as saying that, the pace of change has increased and that, modes don't last as long as they used to, right? So you have, a situation where basically, there's the Amazon platform companies, Facebook, Google, Amazon, so forth, Netflix, and they're disrupting economic realities at a faster pace. So I think that you have to be wary and be careful about basically business models that are negatively impacted by change. I don't think that modes have changed per se. I mean, I think that it's still important for a business to do something unique that allows it to earn an excess return on capital over time. And I think that, whether it's a low cost position or, a differentiated product or patent protection for that differentiated product or, economies of network or something like that, those kind of the typical sources of competitive advantage, I think that they're still relevant. I just think that you have to be more and more careful as an investor looking at how can these sources of competitive advantage be disrupted by others. So I guess my kind of summary would be no, these sources of competitive advantage really, these competitive advantages haven't gone away or diminished in importance, but there are probably fewer companies who have them, and they probably don't hold on to them for as long as they used to in the past. Let's see, any other questions? Well, I'm gonna give you guys one more minute or so. If anyone wants to type in some questions, please feel free to do so on the webpage in the chat box below the video. Otherwise, we'll wrap up. Oh, so we have a question that's asking, what do you think about airline investments by Buffett? So, I look at airlines, both before this, situation that started and more recently, and I passed both times, not because I thought that they were going to go down a lot, but I just couldn't figure out, if the business were as good as the bulls were arguing. So the argument for the airlines was twofold, right? The first part of the argument was that, it's a much more concentrated industry with the top four having 80% plus of the market share, and that should help pricing stability and just make it a better business. And the second point is that they have these really lucrative credit card deals. I don't know, the last time you flew, if you say you flew American, they're really trying to sell you their, partner credit card. That's not an accident. They actually make a very strong recurring cash flow stream from that credit card partnership they have with whoever, with American Express or some Visa or something, something like that. So you had these two factors, higher concentration and a change in the business model that makes this a better business, that you can make an argument that this is, making them better businesses, and the stocks were pretty cheap, right? Arguing against that is that, hey, these are, capital intensive, cyclical businesses in a commodity industry, and that every time someone has said this time is different for investing in businesses like that, they've lost money. And it's almost unfortunate, well, it is unfortunate, but we're really not going to find out, because I don't think that the thesis of people who did not invest in airlines was that, some crisis is going to occur and they're going to go bankrupt. I don't think people thought that. People just didn't really buy into these two arguments. So I don't think we're going to get a fair test of what would have happened had these companies been, just subjected to a normal recession, as opposed to basically the government's showing up and saying you can't fly, more or less, or if it's not even that, it's not happening, it's pretty close to that. So I think that, we're not going to know. I think that based on the facts that Buffett had at the time, he made a reasonable decision. I also genuinely don't think, and I hope some of my friends, who do own airlines don't take offense, but this is my personal opinion. I can be wrong, but it is my opinion that if Warren Buffett were managing, I don't know, $100 million instead of, I don't know, $500 billion, I don't think he would have been buying airlines. No, I think that he genuinely thought that they were good investments in absolute terms. So it's not like he was making bad investments because of his size, but I think that I would be shocked if that would have been Warren Buffett's best possible investment if he were managing much smaller sums of money. So I think that this was a business that he could put a heavy amount of capital in, that he thought he was going to do well in, and he lost some money, and he, to his credit, cut his losses, because it's interesting because a lot of people who are value investors, they are wired to almost automatically buy on weakness, right? If your stock goes down, you should buy more because you're a value investor, and that's what value investors do. And I think Buffett, he talked about the airline business. He said, look, even when this thing passes, as far as coronavirus, there's going to be overcapacity for quite a long period of time, right? And so, we know what commodity businesses will do during overcapacity period. So on the one hand, you probably, there's a good chance you're going to dilute your equity holders in the meantime. And then after that, the chances are for a number of years, your economics are not going to be nearly as good. So he clearly didn't think that the current prices justified the risk. And I don't blame him. I looked at them recently, and I thought they were still in the too tough category. So maybe I'm wrong. Time will tell, and maybe these are great bargains. But these are certainly not easy and investments to make, which are quote unquote obvious. So we have another question. Will consumption-driven recovery be possible in the next 3 to 4 months? Yeah. So again, I will preface this with I obviously don't know, because if I knew for sure, I would be able to tell the future. So I don't have a crystal ball that's perfect, but I'm very suspicious of it. So let's just think from first principles for a second, right? Let's say you work for a business, and that business had to furlough you because they couldn't afford to pay you. But then let's say we open up our society, and the business calls and say, hey, John, come back to work, and you come back to work. Well, let's say there's John before you were furloughed and couldn't work, and John after. Do you really think that you're spending as heartily and in such a carefree way after you were furloughed as before? I don't think you are. I think that you basically are going to be very, very cautious, because you're not sure. What if things get worse? What if you get fired and can't find a job? So I think a lot of it has to do with just expectations, consumer expectations of the future, and people are scared, and they're right to be scared. These are scary times. So I'm not saying they should be scared and live in a bunker. I'm saying that this is if you are a regular person and you don't have giant savings for frivolous expenses, this is maybe a time to be a little circumspect with your purchases. So I think that we're not going to get a very quick snap back. It seems extremely unlikely, and that's even assuming that the whole virus situation is conquered. So I'm not going to get into second wave. Will that happen? Will it not happen? Well, let's assume we get past the virus. I still think that it'll take the economy quite a bit of time to work through its issues. So I don't know how bad it will be, but I am not betting on a quick recovery. I also don't think this initially has to be the Great Depression, but I would say that 3 to 4 months, which is I think what you were asking about, I would say it's too quick. I mean, I would say we will be lucky if we have recovered in 18 months. Like, that would be a very good outcome in my view. So we have a question. What do you think of Buffett going on the record saying his successor will be better than him? I think that's just Buffett being Buffett. Buffett loves to say positive things and praise people. His successor is not going to be better than him. This is not going to happen. There's not going to be another Warren Buffett. That doesn't mean his successor or successors, as the role is likely to be split, are going to be bad, but they're not Warren Buffett, right? And so I think that we can expect honest, above average managers, both on the investment side and on the, you know, the operational side. But I don't think that we should expect, business geniuses of unparalleled proportion. And I think it's also, even for business genius, going to be hard to really make a dent in a large company. I would say one thing that I didn't mention that's probably worth mentioning, is Buffett or his successor. Buffett talked about the possible litigation that's going to arise of all of this. And one of the things that kind of struck me is that he is keeping so much more dry powder on the sidelines now, because he didn't say, so he has 130 billion or so in cash. He didn't say his usual of 20 billion is the kind of for a rainy day, the rest I could spend. He kind of said 50, So he's really worried, I don't know. And I don't think he's worried necessarily about the contracts hero, because I think he's comfortable in the contracts that, but either he or his successor are going to be, potentially litigating and facing huge societal pressure from government, from pressure groups, to pay out claims for things that technically weren't being insured. And I think we're already kind of seeing some pressures like that. I'll give a unrelated example. There's a company that some of you might have heard of called Gilead, and has a drug that's been approved for emergency use for serious patients from coronavirus, and the drug is called remdesivir. And the company had a earnings call very recently, and they basically said, we're thinking for the right pricing model. Okay, that's reasonable. We want to make, I think they should be thinking for the right pricing model. And all the analysts kept asking them questions, and they kept kind of dodging the questions. And then finally, one analyst said, look, we understand that you have to figure out your pricing model. Can you just please tell us, will you be planning on making a positive profit margin on this drug? And they dodged the question. They did not answer it. So here's, so there are these pressures, whether it's society, whether it's government, explicit or implicit, to behave in ways that's different than capitalism is telling you you're allowed to behave. So will there be pressures on Berkshire Hathaway to, pay out? How will either Buffett or the next person navigate them? Hopefully it's still Buffett, but you never know. So I don't think that, he really meant that the next person is going to be better than him. I think he's hoping that he's trying to kind of prop up the image of his successors, understandably. But I think most of us understand that, if we get someone who's close to as good as him, we should consider ourselves lucky. So there's a question: while various industries will take different times to recover, do you see any industry being permanently impacted by the pandemic? So I think that you can make an argument that there is a experiment going on in terms of habits, and habits are very powerful, right? So if you do something the same way day in, day out, that you are likely going to keep doing that kind of, your brain just short circuits it. And so when you have habits and the habits are getting disrupted, and you start forming new habits, then maybe these new habits will become the norm. So obvious one is working from home, using Zoom, right, and less travel. So, will companies, for instance, reassess to some degree business travel, because maybe we stay in isolation for whatever 3 to 6 months, and we all find out that, oh, actually, we don't need to go to all these conferences, which, by the way, I'd argue we don't anyway. Half of them are at least boondoggles, so people can go someplace nice and schmooze with their buddies and get away from the house for a few days. But let's leave it aside. So companies say, hey, look, we did okay. We don't need to go out and travel as much. Now, I'm not saying that people will not travel, but I think that we were forced into an experiment by the government, by the situation, that would not have occurred otherwise. So I think that there is going to be, pressure on certain industries, and they're positive and negative. Now, I think some of the basics are not going to change. Like, do I think that people will go out to restaurants again? Absolutely. And whenever the economy recovers, will it be as much or more? I think so, because those reasons haven't changed. Like, I bet you a lot of you would welcome a nice meal out with your friends, significant others, and so forth. So I think that there are businesses that are temporarily depressed, and then there are businesses where we just don't know to what degree will the changes be permanent. So, for instance, a company like Netflix, people are stuck at home; they're watching a lot more streaming. Is that permanent? Is that are they going to create a new habit? Maybe, or maybe this is just filler, and they're gonna, not gonna have time to watch as much, and they're gonna go back to their old ways in the past. Or another example is movie theaters. Maybe we find out that the industry decides, well, we don't need movie theaters. We're just gonna release movies straight to the consumer, and we'll be fine economically. So there are all these experiments. So I think it's impossible to know, but that's one of the things I'm trying to think through as I'm analyzing investments. I'm always starting with the perspective of, is the change structural or temporary? So is it permanent or temporary? And I'm certainly very cautious of making sure that I don't take it on a situation where I think the problem is temporary, but in reality it's permanent, because that's how you lose a lot of money, right? So I don't know if there are any other questions. Feel free to ask. I'm going to wait for a minute, and if not, then we'll wrap up. So there's a question, and I'm going to just read it verbatim. Have you found any opportunities that are in the category of companies that were on your watch list and have fallen to an attractive price due to the correction? The answer is yes, I have. I'm not going to talk about specific investments because, frankly, I don't think it helps people to have professionals in a wide open forum give specific investment advice, or even just say what they're buying and selling. But I have been able to, and I would say a lot of, I've added some new investments to the partnership in a small way. I've also been able to buy certain smaller companies that sold off to levels that I thought were absurd, and make them much bigger positions. Time will tell if I'm right. Investing is a humbling endeavor, so there's, you can think something is absurdly cheap and find out you were wrong, but so far, I don't have any evidence that I'm wrong. And I think it was just a panic, and you have small illiquid stocks that a larger fund manager would not be able to buy, which, by the way, is one of the advantages I have, is that I'm not managing $10 billion, so I don't have to restrict my investments to only very large, if mostly efficiently priced companies. I can go and look at some of the smaller companies where the price to value gaps occasionally become so absurdly wide that would never happen in a larger, more efficient company, efficiently priced company. So I think there have been several instances where, on the process basis, based on what I know at the time, what I knew at the time, what I know now, I'm very happy with these purchases, and I believe that on a 3 to 5 year basis, they will serve me and my partners very well. Time will tell if I'm right, but I certainly have been able to find some things. So we have a question here. I'm just going to read it. Hi, Gary. I jumped on late and didn't see the whole presentation. Buffett talked about the airlines not having essentially a fast recovery. Do you see the same thing with hotel travel companies such as Hilton, Marriott, Hyatt, etc.? They will have a large supply of rooms available and possibly will have to discount in order to compete and maintain occupancy. So I do think that that logic applies. I think that for so I think it will impact companies somewhat differently, because someone like a hotel, especially if they're a franchisor or a management company, don't own the physical real estate. They just get the fees from the hotels, so their own economics will not be impacted nearly as much as their as the airlines, because the airlines essentially own the assets, and a lot of hotels in recent years have changed from owning the assets to separating ownership of the hotels from the management and the collection of the franchise fees. So I think, say the hotels would probably do a bit better than the airlines, but I think in general, whenever you have a recession, you're going to have an imbalance, and the supply doesn't change very quickly and demand drops, so you're going to have low capacity utilization. But that's not unusual, right? That's not a characteristic that's different from a lot of other recessions. What would be unusual is if we find out that there's a stair step down in the usage on a long-term basis after we recover from the recession of, say, hotels, because people are just afraid of travel. Like, and that I think is unlikely to happen. And here's why. I mean, yes, I mean maybe there'll be a little bit less business travel and stuff, but I think that people like to travel. And to use cruise lines as an example, so cruise lines have had all kinds of outbreaks on them in the past: SARS, Legionnaire's disease. It happens, all kinds of stomach bugs, and it's in the news. For a while, people don't travel, say, "Oh, you'd be crazy to go on a cruise. It's this contained environment, and it's a death trap." And guess what? A year later, 18 months later, people go cruising again, and they have new highs in terms of demand. People forget, or they when something is very vivid and recent, there's a recency bias, and once you kind of get past it a certain way, you kind of say, hey, I want to get out, I want to live my life. Yeah, maybe there's some vague risk of something happening, but you know what? There's a risk of getting hit by a car on the street. It doesn't mean I'm gonna live in my basement all my life and get Domino's delivered through the hole in the door. So I think that for a lot of these businesses, there's not going to be a structural stair step down, but there could be a prolonged 3-4 year recession in the worst case, and that could hurt them pretty badly in the meantime. So there's a question. I'm going to just keep reading out loud. Thank you for sharing your insights with us. You're welcome. Do you expect Buffett to break up the conglomerate in the future? I don't. I mean, he just talked about, again, how it makes no sense, how the businesses complement, are stronger together. And I just think that, he talked about the tax implications. So I believe that he is not going to break up the business. And I think that he's basically expressed that view strongly enough that his successors are also likely to resist the pressure to do so. So I think that that's kind of off the table. He's been very transparent about that. So I don't think we should expect that to happen. So there's another question. What is your view on the interest rate? It looks like Buffett is not scared of negative interest rates. So again, I'm a microeconomic driven value investor, so I don't have the crystal ball on interest rates. But I would say interest rates have been pretty crazy for a while. It is pretty insane to lend money to the government at negative real rates for 10 years, meaning the Federal Reserve says we're going to try to maintain 2% inflation. By the way, they might cause hyperinflation with their policies, but we don't know if they will or won't. But let's take them at their word and assume that they're successful in maintaining a 2% inflation, and they're paying you less than 1% to give them money for 10 years. Like, does that sound like a good deal? No, it does not. It's crazy. Like if you are investing in 10-year bonds right now, I would, and you're not just trading them, but you actually think you're going to hold them to maturity. I would love to hear a perspective on why you think that makes sense. The only one I can think of is, do you expect deflation, and therefore you think that 1% or 0.5% is going to be a good rate of return? But I think that's not what most people expect. So I think most people are just doing it by default. The policy actually is known as financial repression, which, if it sounds ominous, it is, because let's think about what's happening. The government is issuing IOUs, obligations, and then another kind of quasi part of the government, the Federal Reserve, is printing fake money, more or less. It's not fake, but it's kind of might as well be, to buy up the same IOUs to depress the rates, right? So I think it's all uncharted territory. I think that neither I nor the policymakers really fully understand the long-term implications of what they're doing. And I think that they're prioritizing, kind of in their mind, they're trying to save a drowning, company or drowning economy, and they're going to worry about the consequences later. And they think, well, we'll just deal with it later. We'll adjust our policy when appropriate. Well, here's the problem, guys. I grew up in the former Soviet Union, and all autocrats, who run command and control economies, think that they're so smart they can figure out, what prices should be, what quantities should be. And unfortunately, if you look at the history of the world, the wealthiest societies have not been communist, they've not been socialist, they've been capitalist societies. And that's even if you measure by the poor in capitalist societies are probably better than a number of the rich in some of the communist societies, or at least the middle class, if there is such a thing. So I think it's very dangerous and arrogant for some technocrat to think that because they have some degree and they've studied some charts and data series and analyzed economics, that they all of a sudden are masters of all the economic forces out there, and they can understand fully the implications of what they're doing. I think that the government's playing with fire as far as interest rates, but I also think that they feel there's no choice, because they feel that if they don't do it, there's going to be a Great Depression level recession, and that's what they're trying to avoid. I don't envy their choice, but I think that over the next 10 years, we might find out and that the consequences of what they're doing right now are not to our liking. So I'm going to pause for another minute or so to see if there are other questions. So I think there was a question. Is this being recorded? Yes, this is being recorded. So I'm gonna later on post this to my YouTube channel and share it openly. Again, take it with a grain of salt. These are my own opinions. I'm just kind of sharing my thoughts and my observations. I don't have all the answers by any means. So I think that hopefully that's clear. But at the same time, why not? The more people who watch it, the merrier. Any other questions? Otherwise, we'll call it there. So we have a question. Do I recommend raising cash or staying invested? So, I understand the question. I understand why it's tempting to think about raising cash in this environment. But I also think that timing the market is a very, very, very difficult thing to do. And I don't think that I know anyone who's done it well consistently. So I think what I would recommend is that you have a thoughtful process and investment strategy that makes sense to you, and that you stick to it. So let's say for a lot of people, it might be as simple as dollar cost averaging. So let's say you decide that you're going to save X% of your paycheck, and you're going to invest it however you're going to invest it, and you're going to do that every month. So just do that. I think trying to guess the market is very hard. I think that that's my standard answer, and it applies here. I mean, I also cringe a little bit giving that answer, because I think that someone who owns the broad market as their investment portfolio could see a very, very substantial drop in the value of their holdings over the next 2-3 years, 4 years. So you need to make sure that your affairs are set up in a way that you don't need the money that you're investing in stocks for hopefully 5 years plus. And you also need to be aware that, look, this is an expensive market. It was very expensive, and the fact that it's down 12% does not make it cheap. It would not even make it cheap in my view, in terms of kind of the broad selection of stocks and securities concerned, if there were no economic shock. So if you told me, Gary, let's look at a scenario, and there is no coronavirus, there's no economic recession, and the stock market just went down 12% for no reason, do you think the opportunity is attractive? I would say absolutely not. This would not be an attractive market. No, maybe you can find a few attractive things here and there, but it would not be a market full of bargains. And now we're changing the scenario to, by the way, there's a huge economic shock. We don't know the magnitude, but it's between bad and very, very bad, somewhere in that range. You can see the technical terms here. And is that 12% sell-off? How does that sound? Well, it sounds woefully inadequate. Now, does that mean the market should sell off by a certain amount? Absolutely not. But I'm not looking at markets. I'm looking at individual securities. I'm constantly searching for companies I understand that are selling at a big margin of safety in terms of a discount to intrinsic value. And I'm not finding very much right now. It's not like I could rattle off a list of 20 deep bargains to you. If you have that list, send me a private email. I would love to learn from you. But I'm not finding all that much that's amazing. So I'm very cautious in the way I've positioned my partnership in general terms. Again, I'm not going to talk about specific securities, but in general terms, I've made sure that if there is a giant market crash and collapse, that we are protected. But at the same time, I'm investing and moving forward with caution, but forward with certain investments, which in a lot of cases I think are trading at below 50% of my value. So if I think their businesses are worth 100, my portfolio right now is being priced by the market at less than $50, so less than half of what it's worth. So I don't want to sit there and time the market. I think that I would say I like the investments I have, but I'm very, very cautious. And I think that if the market were to sell off 30, 40%, we would be pretty well protected. But that's not so, again, if you're a regular person and you're kind of investing your own, savings, I'm not sure that that's something that you would be able to replicate in your, but again, I do this for a living, so I think it's my job to make sure that if things go wrong, we don't lose our shirts. So there's a question of what are your favorite 3 to 4 investment books? How does one build investment wisdom? Okay, yeah, that's a great question. So I have an article on behavioralvalueinvestor.com, which talks about kind of the sequence of books to read if you want to become a good investor. And basically, that's the same sequence that I used to teach my value investing seminar at the F.W. Olin Graduate School of Business, where I teach it. So I think that it depends on if you are where you are in your development. But if you're just starting, I would say The Intelligent Investor is kind of an easy book, a layperson's guide to value investing. It just gives you the couple of mental models. But I think though, reading that book is not going to make you a master investor. It's just not. And then what I do with my students, whether I mentor people who I mentor one-on-one, people who work for me, or my class, I start with security analysis. And sometimes people say, well, security analysis is such a dense book. It's hard. Yeah, it's hard. But guess what? Investing is hard. If you think investing shouldn't be hard, and you can read some pop culture books, listen to some talking head on CNBC, and you can be an investor, you're kidding yourself. So I always start people with Security Analysis by Benjamin Graham. And by the way, that weeds out people who are not serious about it very, very quickly. So I think that's a great start. The next book I recommend is Philip Fisher's Common Stocks and Uncommon Profits. And the reason is Graham is a much more quantitative, analytical approach, focused on numbers and financial statement analysis. Fisher's approach is much more focused on qualitative aspects, intangibles, management, culture, and so forth. So I think they're both intelligent approaches, and they kind of span the gamut of intelligent intrinsic value investing. And then I progress people to Buffett's partnership letters and Berkshire Hathaway letters. And from there are a few other a bunch of good books. I'm not going to go into all of them. You can go to behavioralvalueinvestor.com, all one word, and then go and find the article on, I believe it's called something like Good Books That Will Make You a Good Investor, or the best books that will make you a good investor. But it's a lifelong journey. Look, I've been doing this for 20 years. I've invested through 2 downturns prior to this, so this is my 3rd. And the longer I do this, the harder I find this. And you can say, well, how is that? Gary, are you getting dumber? Aren't you learning? I am learning. I think earlier I just underestimated, and I was too overconfident about what I was doing. I think that the more humbled I get in the market, and by the way, if you're a serious investor, you're going to get humbled a lot. You're going to get things wrong a lot. Hopefully not as many times as you get things right. But as you get things wrong and you are improving your process and you're building your approach and you're kind of customizing to your own strengths and weaknesses, I think then you become more and more aware of how difficult this is. So I think investing is really a lifelong learning kind of paradigm. It's not just a few books and you're a good investor. It's reading, practicing, learning from your mistakes, learning from your successes, learning from the mistakes of others, rinse and repeat. And I think maybe just to kind of bring this to a conclusion here, back to Buffett, I think that has what has made Buffett such an amazing investor. He has evolved and learned more than any other investor I know, because there are other master investors, right? And they've done very well. They've added a lot of value to their clients, but nobody else has really evolved as much as Buffett has. If you study him when he was working for Ben Graham to where he is today and that full range, he is unique in being able to evolve, both change with the times, but also change as he found better mental models and better ways to invest. So I think that is something that you want to imitate, is like, be flexible as far as learning, but also be rigorous in implementing your best current process at any given time. So we have a question that's asking, besides the Buffett letters, do you have other investor letters that you would recommend? I would say that I read a bunch. I don't want to kind of, pick one or two and offend others. Their Reddit has a subforum on security analysis, subreddit as they call it, on security analysis, and in that subreddit, the person who runs it posts a lot of letters of smaller value investors in there. I like to read those. The reason is basically, if you think about a great investor, let's say Seth Klarman or Warren Buffett, by their virtue of their success, they're managing so much money that their opportunity set is naturally restricted mostly to very large securities. So if they're buying something, it might not be something that they would be buying if they were managing $100 million, right? And I'm much more interested in what would Warren Buffett buy if he were managing $100 million, but he's not going to tell me in his letter or anywhere else. So I think reading some of the maybe less proven but more opportunistic managers' letters gives me kind of a sense of where else should I be looking for value that maybe I'm missing. I would say recently, I'll give you actually one specific one. It's not one I usually read, but I read it and I thought it was really good, and I would recommend it to you. So Paul Singer from Elliott, Capital Management, he wrote this kind of perspectives letter about the current situation, and I would highly recommend reading it because I think the quote that stuck with me from it is he said, if you're a long only investor and you're not waking up in the middle of the night, given all that's happening right now, then you're either cool hand Luke or you're oblivious. And I think he's implying that people are oblivious. And I think that that's what's happening in the markets. A lot of people think that this will blow over, this is business as usual. And I think that there is a probability that they're right, but they're missing a whole chunk of possibility of how this could be drastically different than their mental model, and their fully invested long-only portfolios could implode over the next couple of years. Maybe not, but I think it's a distinct possibility, and I think that it's something to guard against if you're an investor and you care about compounding your wealth long-term. So we have one more question. What are your thoughts about Graham sort of discounting how important it is to conduct security analysis before his death? It is commonly pointed to as an argument in the camp of efficient market theory. Well, it depends on who you are, right? I think Buffett addressed this during the call. He said, look, most managers don't add value, and it's very hard to identify in advance the managers that do add value. That's all true. And by the way, I think that most people should be investing in passive index funds. And the reason is that they can't figure out who the good manager is. They're much more likely to be influenced by slick marketers who are going to take advantage of them and pretend to be they're going to pretend to be good managers when they're really not. So I think it makes sense for them to stay invested in low-cost index funds. But I think that even Buffett admits that there are a small handful of really good managers who can and will beat the market. And I think in his 1984, I think it was 84, maybe, but it's in the 80s, I believe, speech, The Super Investors of Grahamsville and Doddsville, he kind of explained that he believes that value managers following a rigorous security analysis process are likely as a group to do better than the market over the long term, even though they're investing in very different securities. And I believe that that's been the case. Now, it hasn't been the case the last 10 years, but part of the reason value investing works is because it doesn't work every single time period. Otherwise, it would just be too easy, and everyone would do it. So anyway, I don't think that Graham didn't think that he had his then current knowledge and he was 40 years old, that he couldn't beat the market. I really don't. Now, is the average person doing a full-time job, are they going to be able to build their own investment process? And are they going to be able to, beat the market? I highly doubt it, which is why I don't think they should try it. I think the vast majority should stay in the passive index fund. I think if you're sophisticated and you understand what to look for in a manager, you can try to find one who's good. But I think that's very hard, and I would not lie to someone and say it's not. So there's another question. We'll take a couple of more, and then we'll end it at the top of the hour. Do you offer investment classes or online workshops or seminar? I don't. I teach a value investing seminar at a business school here in Boston to a group of students every year. I also kind of teach the similar version of it one-on-one to people who intern with me remotely, or in some cases in person when that's available. I think that that's appropriate. My main activity is managing the partnership for the families and organizations that individuals have been trusted with their capital, and most of my own capital is in that partnership as well. So I don't want to kind of dilute that by saying $199 for a great seminar investing. Plus, that would be kind of being like fraud, because you can't become a great investor in a 12-course series. But I do, when I teach the value investing seminar, is we study great masters together in their philosophies, and I try to set people on the right path that will require a substantial amount of further learning on their own for them to become good investors. So I wouldn't want to basically run a seminar and charge people money to teach them how to be an investor. I think people who do that, well, I don't want to say anything bad, but it's not what I want to do. Let's put it that way. And who are your investment heroes outside of Warren Buffett? I really look up to Seth Klarman, the Baupost Group here in Boston. I like that he's a humble guy. He's not there on CNBC mouthing off and trying to boost his ego. He's not trying to make as much money as possible from his partners. He's given money back in a lot of cases when he couldn't find opportunities. Try to find a mutual fund company of any size that's given money back to their investors. Good. Please email me if you find it. I would like to know. So I think like people like that who are good investors, but they're also good people, and they're trying to do the right thing by their clients, and they're not just trying to make money off of them, but they're really trying to, make money with them and for them. I think that those are the people who have my vote. I would say, there are not that many of them. There's way too many kind of hedge fund master of the universe types, or fancy pants mutual fund manager who went to fancy business school and looks the part, but when you get right down to it, doesn't always necessarily know how to do the part, kind of folks. And I think in that sea of mediocrity and marketing slickness, there are a few giants who do it right, do it well, and they're also all people I would genuinely enjoy having a glass of wine with, as opposed to people who maybe they're great investors, but they're arrogant and not people I would want to be around. So Seth Klarman stands out, but I don't want to. I'm sure there are several number of more as well. So let's make this the last question. So the question is, how can someone serious get into your business class or something like that? So it's a good question. Send me an email. I don't know if they'll allow people who are not students at the business school, but I would be open to it if they did. Ultimately, I come in and I teach the students, and I do have a say about who joins the class, and I definitely have the right to kick anyone out who's not doing the work, because I'm not interested in teaching people who don't want to learn. But at the same time, I wouldn't want to speak for them. So I don't know if they would allow people from outside the business school to take the class. But send me an email and I can ask if you're local. So with that, let me wrap up here. And I thank you for everyone. So again, hopefully you got something out of this, and I will post this on the YouTube channel if you missed it, probably in a day or two. And really appreciate your time, and check out the Behavioral Value Investor website if you think that that is something that is going to be interesting to you. Thank you, guys.